Hi, my name is Arun. In today's short video, I'm going to talk about account size versus risk. Before we start, as at least disclaimer, I'm not a financial advisor or a consultant, so options are risky. There is a possibility to have unlimited losses if you don't know what you are doing. As and this video is only for learning and educational purposes. Okay, let's take a look at this slide. Basically, what I'm showing here is the different account sizes. So here, what is representing in this corner is the account size of 5,000 euros. And here you can see an account size of 10,000 euros, 25,000 euros, and 100,000 euros. Yeah, I'll come to the max allocation line item later. But let's take a look at the other items here. Yes. So if, as an example, you have an account size of 5,000, ideally, what is recommended is to have exposure or a risk per trade basically on the lower side of the spectrum. So basically, usually it should be 1 to 2%, but since having a 1 to 2% risk per trade will not give you a good trades to put on. So I've taken 3% here. So with 3% at risk, basically what you are saying is per trade you can risk 150 euros of an amount. If you go with the 3% allocation per trade, this will allow you to have 33 possible trades, assuming you will lose all. So at least you can do 30 trades before you will blow up your account. Yeah. Ideally, if you will allocate more or you have a more at risk per trade, then the possible trades which you can have is lower. So with the 5% allocation per trade or 250 euros at risk per trade, you can only have 20 possible trades, assuming these are all losers. And if you go to a bigger 7%, then the only possible trades is 14. So if you lose 14 trades or 14 option trades, you will have your account blown. Yeah, so you will have a zero in your account. That's why it is really, really important that you allocate 1 to 2% uh, risk per trade, and at least at any particular time, you should not allocate more than 40% of your account, full account. So basically, what does it mean is, so you have, let's say, 3% risk amount per trade, which is 150 euros. It means at any time, you should not have more than 13 trades risking 150 euros each at any time. This 40 is also on the higher side. Usually, people who are doing are trading bigger accounts, they are in the 20 to 30% range. If we take a look at the 10,000 account now, so you see I have lowered the amount to 2% here. Now at least the risk amount per trade is 200 here, which will give you a possibility to trade up to 50 times. So if you lose 50 trades in a row, then at least all your account is blown. And if you allocate 4%, then it's only giving you 25 trades, basically when the account is blown. If you take a look at the 25,000 and 100,000 trade, just to give a view, if you see here, I have lowered the amount to 1%. The risk amount here has increased per trade. So if you will have a 3% trade on a 100,000 account, yes, or the 3% risk amount on a 100,000 account, you can only do 33 losing trades. Basically, you will lose 100,000 euros or dollars if you allocate more risk amount per trade. That's why when your account grows and the account which you're using for options trading, it is important that the exposure or the risk amount per trade is 1 to 2%, not more. At least the idea is that you live another day to trade more. So I'm expecting, or at least we are expecting, that we will not have a 50 losing trades. Yes. With this, you have to lose 25 times to really blow your 10,000 account. With this amount, and if you go with maybe 5% or 7% in 100,000 account, you will blow your account very soon. That's why it's important that you give yourself a lot of probability of winning those trades and make some money out of it. Okay. Now, if we look at this, keeping this in mind, this will also impact what you can actually trade or not trade. So, what are your strategies? What is your risk budget per trade? And also, what are the maximum possible trades at any point of time? If we go further, if we are trading defined risk strategies, I think in defined risk strategies, it is clear. Yes, if we say, let's say, take an example of 5% rule here for a 5,000 account, so 5,000. So the max risk, what is suggested here is to risk 250 euros per trade. So if it is a defined risk strategy where you are buying call or put options, basically long trades, then it is pretty clear. Yeah. So that, okay, so one contract up to 250 is what you can do. So you're doing a 50 euro contract, let's say call contract, then you can do up to 5 on that trade as an approach. And same is the case also with the vertical spreads or defined risk strategies. Basically, it's clear from the start what is your max loss. So the amount of 2, 3, or 5% as per your account should be defined based on the max loss which is there. But when it comes to undefined risk strategies, and that's where it gets trickier. Yes, let's take an example first, a tricky example of selling one call option. So the max gain is of course the premium received, but in this case the max loss is unlimited. Let's say you have sold a contract of ABC at a 20 strike price for $2 or €2 per contract. If the stock is rose to 25, then at least you lose 3 euros, let's say, per contract, since you have got 2 as in premium. So hypothetically, this 20 euro stock can go to unlimited. Uh, think it of GME or AMC. Yeah? So if it keeps on rising, you tend to lose unlimited on such an account. On the other side, if you're selling one put option, the max gain again is the premium received. But in theory, the max loss is the price of the underlying. So if your strike price is, let's say, at 10, the max loss is 10 times 100 shares minus the premium received. So that's the max loss which you will have. In my case, since I'm selling puts, I'm keeping complete amount, let's say, which is shown above as an example for my risk management. In other cases, of course, you can keep your losses to limited by using stop losses. But of course, there are also risks associated with stop losses. Sometimes they are not triggered if the market is dropping fast, or they are triggering with a lot of slippage. So if you're thinking, okay, it should stop at 2 times the loss, it could happen that you have a 4 times loss. So that's possible. So that's why it's very important you understand what you're doing before you actually going into options trading. Maybe I take an example. Yes, in my case, I'm using a 5K account for learning. Uh, I'm using that amount as a margin provided by Degiro against my share. So I have all my amount which is used for the shares which I purchased, and then Degiro is giving me margin on top of my shares to trade. I'm usually going with the 50% rule. So at any point of time, I'm not going beyond 2,500 euros of risk because I'm learning and also have a small account. So there is a probability of blowing it up quickly as an approach. So with higher accounts, even the recommendation, as I mentioned earlier, is to be somewhere between 20 to even 40%. Yeah. So depending on your risk margin and depending on your experience and what you want to gain, you have been gaining over the last couple of years. The key takeaways, at least from this, in my view, would be never trade more than 2 to 3% per trade of your account size. Yes, if you feel at some time you can make more money by trading large, don't do it. Just always trade 2 to 3%. The idea is to live another day to trade more. Yeah, so that's the key thing here. So in case you have liked the video and content, please like and subscribe. Thank you. Bye. Ciao.